What is private equity and why do they buy entire companies? Imagine this. An investment firm buys an entire company, pays millions or even billions, restructures everything, and sells it a few years later for a huge profit. Sounds like a movie? Welcome to the world of private equity. In this video, you'll learn what private equity really is, why companies get bought out, and whether that's good or dangerous. Chapter 1. What is private equity? Private equity literally means private capital. More precisely, it's money from investors that is invested in non-public companies, or in companies that are deliberately taken off the stock exchange to be restructured away from the public spotlight. The goal: buy, improve, make more profitable, and sell for a gain. Typical private equity firms include Blackstone, KKR, Carlyle, or EQT. Chapter 2. Why buy entire companies? The idea is simple. A company is acquired completely or at least with a majority stake, so the investor has full control, no shareholders, no stock market rules. Then the value creation begins. Typical strategies include cutting costs, improving efficiency, selling off subsidiaries, so-called asset stripping, merging with other companies, buy and build, expanding into new markets, replacing management. After a few years, the company is sold again, either to another investor or taken back to the stock market through an IPO. Chapter 3. How do they make money? Let's say a private equity firm buys a company for $100 million. They contribute only $30 million in equity and finance the remaining $70 million through loans, leverage. After 5 years, the company has grown and improved and is now worth $150 million. The debt of $70 million still exists, so $150 million value, $70 million debt, Lupauks $80 million equity. Their initial $30 million investment has become $80 million. That's a return of around 167%, or simply put, the invested capital nearly tripled. Additional earnings often include dividend payments during the holding period, fees, and management compensation. Chapter 4. The dark side. What's the problem? Private equity is controversial. Criticism includes costs are shifted to employees, layoffs, cuts. High debt threatens long-term stability and creates financial risk. Focus on short-term profits rather than sustainable growth. Lack of transparency, since private companies have fewer disclosure obligations. And finally, many companies don't survive the treatment. About 30% of acquired companies go bankrupt, which is much higher than the approximately 2% 10-year bankruptcy rate for public companies. Conclusion: private equity can make companies leaner, grow faster, and bring high returns to investors. But the method is often brutally efficient. Who pays the price in the end? Employees, customers, or no one? If it all goes well, what do you think? Let us know in the comments. We hope this video helped explain and visualize the topic of private equity. We'd really appreciate a like and a subscription for more videos. Thanks a lot, and see you next time, and have a good one.